Greetings, class. We're going to go through the Chapter 6 PowerPoints in this video. And since we're not meeting in class physically in the classroom anymore, what I'm going to do is record a session here in using this screen capture software and put the video online in Canvas as we go through this PowerPoint and describe what's in the chapter 6 that you need to be aware of. Also, in each of the chapters, instead of doing an iClicker response system in class, you will need to complete a short quiz that's worth 10 points in Canvas, and you will have an unlimited number of attempts to do that so you can score the full 10 points. First of all, this chapter 6, focuses on loans and housing decisions. We're not going to get too much into the housing part of this. We do want to talk about some serious issues with loans and high cost lending. We want to look at student loans, and then we want to look at car loans, auto loans. So high cost consumer loans are to be avoided almost at all costs, and you can identify these rather easily. They're the alternative lenders. If you are having trouble getting a loan at, say, a bank or a credit union, or even going through a car dealership to get loans through auto financing, usually the auto financing companies are a little bit easier to get financing through than the banks or credit unions. But there may be a case where you have difficulty doing that as well. Credit card is considered a source of lending. That's mainstream, like Visa, MasterCard, or whatever. Merchant credit cards are another source of mainstream lending, and these are usually from places like Kohl's or Target, where you can actually get a credit card issued by the store itself. Go into the store and make purchases on that card, and then pay whatever you owe to the store. Now, those are mainstream in that the interest rates are relatively inexpensive if you do have an interest charge on them. However, alternative lending is really going to be for places where you don't really have an established credit record, or you may have some difficulty getting a credit at one of these other places. These places are going to be very expensive. Usually you can lump these first three together: check cashers, payday lenders, and title loans. Now, several years ago, there were check cashers who basically what they did was they would cash your payroll check in exchange for a significant fee, and then you took the cash and basically did with it what you wanted. That's if you didn't have a bank account. That's different from what we're seeing today as a check loan place, where basically you go into the check loan advance place, you write a check, they give you a sum of money that's less than the amount that's on the check you just wrote, and the difference is the interest that you owe them. We'll see why that's a bad idea. That's very similar to the payday lenders who do a very similar thing, basically saying, okay, we're going to get you. They don't make you write a check these days. I believe what they do now is they basically set you up to have it deducted automatically. Title loans are very similar to that. That is a title loan on a vehicle. Doesn't get you what the car's worth, but you're going to pay extremely high interest rates. And then pawn shops, seller financed used car loans. This would be not necessarily for a mainstream auto manufacturer, but this would be for a place that finances. It's a buy here, pay here sort of car lot where you see JD Byrider is one of them that I see around frequently. And basically, you go in there if you're unable to buy a car somewhere else. Oak Motors is another one. Those are both really very large places, but they basically tell you, okay, you can buy the car here, pay for the car here, but your payments are usually set up in those places on a weekly basis, and you're going to pay an extremely high rate of interest for those. So, because of the way these work, they don't usually rely on your credit report as much, but they rely on you borrowing whatever it is that they're issuing to you, the money that you're getting in a loan, it's going to be charged an extremely high rate of interest for that reason. Payday loans are usually repaid within a few weeks, but many times these payday loans become a vicious cycle where the borrower goes in to borrow a short-term amount of money, and then they get stuck into this cycle where they have to pay a large payment back, but they never are able to overcome the fees that are charged in order to actually pay the loan off. So they have this perpetual loan going on where they're paying the payday lender an exorbitant amount of money. There's a story about this in the Netflix series called Dirty Money. Scott Tucker was a race car driver and a payday lender who owned a payday lending business. And he was involved with this business where they charge many times several 100% interest on loans. Basically got arrested, lost his home, lost all of his cars that he had purchased that were racing cars and so on. Basically, I think he had an $8 million home that was seized in the whole process as well. So, I mean, you can watch that video that's on Netflix if you'd like. We're not going to do that here, but that's an example of what this payday lending business does. For that particular case, the problem came in when I believe the individual was running a payday lending business under an exemption allotted to tribal owned businesses, but it wasn't a tribal owned business. So there was a little bit different twist to that. But still, the process of payday lending is a vicious cycle. You can see that here. You borrow $500, you give them a $575 check, and that just continues on and on and on. If you don't pay it back within 2 weeks, they'll cash the check. Anymore, though, it's not a physical check, they'll just take it out of your checking account. So here's the calculation for the interest on this payday lending business. If you're paying $75 in interest for every $500 that you borrow every 2 weeks, you're going to actually pay over the course of a year 391% APR, annual percentage rate, which is exorbitant, which is ridiculous. And many times this is low for some of the payday lenders, depending on who it is that's running it. Pawn shops are also places where you can raise money fast if you need to. If you buy a very expensive item, you may be able to go to the pawn shop, get a little bit of money for it. And the example here is if you buy a $1,000 diamond ring that you purchased and you need money, you go in, you take it in, you pawn it for $400. You get a 3-month loan for that. And if you don't pay it back in that length of time, the pawn shop will keep the ring and sell it. And these are very expensive approaches to borrowing money. This chart identifies some of the different ways that you can borrow money. If you borrow from family or friends, you're very likely not going to pay any interest, and basically no credit requirements are needed. Subsidized student loans are available. You have a very low interest rate. You do have to file a FAFSA form and an income tax return in order to get that. It doesn't rely on your credit score. When you start borrowing money, like an auto loan, personal loan, credit card, and so on, you are going to have a credit score consideration involved, and they will look at that and they'll tell you, okay, well, based on your credit score, based on what you're borrowing and the collateral involved, here's the rate of interest we can offer you. How to avoid these? Well, one good way is to have an emergency fund set aside where you have a source of funds that are outside your paycheck. So let's say you're able to live on less than what you make, and then you have this emergency fund set up. You can withdraw the money from that in order to pay for these emergencies that come up. You can also borrow money from family or friends if you have them available, or obtain traditional lending. Now, many times it depends on where you're at on the financial where your finances are. But if you're barely making ends meet, you're not going to have a whole lot of reserves, and so that's where a lot of folks get tripped up into the payday lending business because they find it as an easy way to raise some money they need for an emergency. Um, so that's expensive loans and how to avoid them. Basically, avoid them by having an emergency fund. For the third 6.3 in the chapter, we're going to talk about financial aid and student loans. Paying for college is expensive, but it's an investment in your human capital. And you do have some options when you look at paying for college. You can work, you can get scholarships, you could have family support, you may have savings set aside, and then there are federal student loans. And generally, these student loans are where many people begin the financial or rely on for financial support during college. So the application process for financial aid begins with the free application for federal student aid, which is a FAFSA form. Basically, you apply for it based on your financial information. You're eligible for a specific award, and your school will let you know what that is. Then, when you graduate, you repay the lender where you borrowed that money from. The kinds of awards you can get to help you through school are typically federal work study. That is where you work on campus, you receive a certain amount of income associated with that work, and it's all subsidized by the federal government, but it helps you pay for college. Another form is a federal grant. Now, there are other grants available from time to time. You'll hear about them, grants and scholarships. But this is not a scholarship. This is a grant, which probably the most familiar grant that's awarded today is the Pell Grant, which is given on the basis of need. These grants are not loans. You don't have to pay them back, but they are much more restricted in terms of how much is available when you're applying for them. Then federal student loans will allow you to pay for school and living expenses while you're in school. And basically, they cover just about every kind of expense you can have while you're in school. There are four kinds of federal student loans. The first one is a direct subsidized loan, and this is what most undergraduate students receive. The subsidized loans mean that while you're in school, the government is subsidizing the interest that's accruing on your loan so that you don't have to worry about it. When you graduate, and if you go to graduate school, you'll probably be involved in taking direct unsubsidized loans if you take any. And that means that the interest accrues during your time in graduate school. So it's advisable to try and pay that interest while you're in school, or to basically deal with it in some other way, because if you allow that interest to accrue, it will cause your indebtedness to increase significantly. The direct plus loans are loans that are available for usually parents of students if they want to borrow money to help their student through school. And then direct consolidation loans, basically, this is as you're in school, when you take out loans, each one's considered separately, but when you finish, you can consolidate all those into one balance. And this is often used as a way to calculate or for specific student loan relief programs like the public service loan forgiveness. You need to have this consolidation take place. So there are some different requirements based on what you borrow. So these direct loans are based on financial need. The subsidized ones are. You have to be enrolled for at least half time to get these, and basically the subsidized loans are the best value. The unsubsidized loan are normally made, usually you can get through undergraduate school with subsidized loans if you need to, but by the time you get to graduate school, this is going to be an unsubsidized loan if you take any out. There's not a need for, or not a financial need to receive them, but there is a cap on how much you can borrow. Plus loans are usually for the parents of undergraduate students. I guess you can get these if you're in graduate school or professional school too. But the interest is calculated on the balance until they're no longer attending school and payments start. The direct consolidation, like I explained, it's basically rolling over all student obligations into one loan to make it easier to manage. So when you begin repayment, you have typically 6 months after you finish school, and then you start the repayment process. Those first 6 months is a grace period, and when you're in that grace period, you make a decision what kind of repayment plan you want to take. There are several approaches to do this, and here is a schedule in the PowerPoint. I'll post these PowerPoints in Canvas so you can see this later, but as you can see, there's a lot of different ways that you can approach these. A standard plan, graduated repayment, extended repayment, revised pay-as-you-earn, income-based repayment, income contingent repayment, and income-sensitive repayment. All of these plans you can look at and decide, okay, which one do I want to take when you finish college. Auto loans, really, when we talk about auto loans, there's a couple things to think about. We need to think about what is an automobile purchase. First of all, it's a use asset, which means that it's intended to support the current level of living that you have as an individual. They depreciate rather quickly, depending on what kind of vehicle you purchase. The most popular use asset is an automobile, but the thing is that over time these need to be replaced. You can't keep them forever. There will be a point in time where it'll wear out, won't work, and won't be serviceable. So here's the deal. If you buy a new car and you drive it home, the moment you drive it home, you take this enormous hit right here in depreciation. That's the value that it declines as soon as you drive it home. So when you drive it off the lot, if you bought it new, and let's say the sticker price on the car was something like $30,000, and you drove it off the lot, almost immediately you can see that price or that value drop significantly. So that if you tried to sell the car after you owned it for a year, you'd have a very difficult time recovering the amount that you may have borrowed on it. Many times when you purchase a new vehicle and you do this, the value on the car drops faster than the value of the loan. So one of the solutions to this when you're purchasing an automobile is just to basically do your research and figure out, okay, what do I actually need? Not what do I want, what do I need? So like when I was younger, I wanted a sports car, right? So sports car, very exciting to look at, very exciting to drive. But one of the things that my father taught me very early on was what you want is maybe not the best value for you. So we looked into a couple of sports cars when I was when I was in my late teens. And I discovered very quickly after doing some of the research that these cars were not necessarily easy to fix or cheap to fix, and they did cost quite a bit to maintain. There was a period of time where there was a vehicle that was available that was a very expensive Italian sports car, and you could actually purchase that vehicle, what sounds today to be a bargain, for approximately $25,000. However, when you started looking at the cost of maintenance for that specific vehicle, some of the maintenance that was required on it would cost you more than the cost of the vehicle over a period of 5 years. So you really need to do that research, and that's what this points out. Specific models. What are you looking at? What do you want? What do you need? You may want a vehicle that looks a certain way or whatever, but as you do your research, you may find, okay, that vehicle is not going to serve my needs. What do I really need? I may really want a car that looks great, that's fast, and all this other stuff. But what I may really need is a vehicle that's dependable, reliable, and gets good gas mileage. And usually those two things are going to be not necessarily go together. So you may not always find a dependable, reliable, high mileage car that's very fun and fast and sporty or whatever. So you just really need to look around at what you can get or what you want. You determine your transportation needs. Do you need to carry a group of people with you? Are you a carpooler? Are you taking people to work with you? Are there four of you driving to work together? If so, you probably need to think about something like a four-door sedan or something bigger. You can't buy a two-seat or two-door coupe because if that's the case, you're not going to be able to meet your transportation needs. And again, calculate what you can afford, look at the costs, and then identify vehicles in your area where you can find something that will meet your needs that actually fits the price that you want to pay. So, how much can you afford? Well, you need to look at your budget to find out. I mean, how much of a car payment can you pay? Um, So there are a couple ways of doing this. First, you could save your money first, which is advisable. If you save your money, you can pay cash for the car. You don't have to worry about car payments. If you use a sizable cash down payment, it will also reduce your payments, and it'll also give you a lower cost in terms of interest over time. If you borrow the entire purchase price of the car, you're going to run into that issue that I talked about earlier, where the price of the car uh, or the value of the car drops faster than the loan balance does. So when you go out to buy a vehicle, you want to identify what it is you're shopping for, but you also want to shop for a loan. You want to talk to some folks about what you're wanting to borrow. I'll give you an example of this. I was looking at purchasing a truck. Well, it actually wasn't. It was honestly not a truck for me. It's a truck for my wife. Um, but it's a truck, and I was looking at it. And when you go out to buy one of those today, those are very much in demand. They're not easy to find. But in this case, I had a truck that I was buying from somebody I knew, and so it was a good purchase price. And when I started looking around at what I could borrow the money for, I shopped at my credit union and so forth, and basically got a very good rate quote. So you want to look at that. You want to say, okay, what kind of interest rate do I need to have? What do I want? Um, you don't want to go out and run a bunch of credit report inquiries on your credit, because that will make your credit score drop. So you want to think about, okay, how long do I want the money for, and what interest rate do I want it to pay? If you're wanting a low interest rate, you want to go to your credit union or your bank, um, and basically you get a better interest rate there. So the lower the interest rate, the more you can borrow. The longer the term, the more you can borrow, but you'll also pay more interest. Um, Here's the thing: is the key variable that you're looking at negotiating is the lowest interest rate possible. So you may go out and say, look, I want to buy a vehicle, and one lender may quote you 6%, another lender may quote you 7%, another lender may quote you 7.5%, but each of them may have different fees associated with the loan. You want to think about, okay, what is the total cost of this loan? Not just the interest rate, but the cost. You do want the lowest rate possible, but there may be other fees built into that that'll make the interest rate effectively higher than what they're quoting you. So if your budget, and this is a really intimidating formula here, but this is a present value calculation for a series of payments. And basically what this does is it takes a payment that you calculate based on your budget. Let's say you have a budget in you're budgeted that you can pay $230 a month. You want a 4-year 5% loan. So 48 payments. And you want to figure out, okay, how much can I borrow to actually do this? Well, at this interest rate for 4 years, you could borrow up to $9,986.49 and still have a $230 payment. So once you figure this out, then you can actually go out and say, okay, look, I need a car, but I need to stay within this price range. Once you know your price range, you can actually narrow your focus on what you're shopping for. Also, when you buy the car, you want to call whoever it is you carry insurance with to get some kind of an estimate on what kind of an insurance premium you're going to pay for that vehicle. Some vehicles have a higher than average risk of being stolen or being crashed or whatever. And so you're going to pay a much higher interest rate. Or not interest rate, you're going to pay a much higher rate for your insurance through those if you go that route. So you can negotiate once you figure this all out. The seller needs to sell the car more than you need to buy it. Whether you recognize that or not, that's usually the case. And usually what can happen is a buyer will go into a dealership or something like that. Somebody will try to identify the amount they're willing to pay for the car. But rather than do that, you'll want to negotiate first. You don't want to give them your bottom dollar as soon as you walk in the door. So you could search the area. That's the thing. Living in where we live in central Indiana, you can look in Indianapolis, you can look Fort Wayne, you can look all over the place. You can actually find a lot of good, reliable, late model used cars at dealerships. Usually these dealerships will take these vehicles in trade, and if they actually keep the vehicle and put it on the lot as a used vehicle, it's going to be a pretty good vehicle. They're going to take the cars that are less desirable and send them to an auction. So if the dealer actually trades in or accepts a trade-in and then puts that vehicle on the lot to sell, usually these are pretty good vehicles for you to look at. The best value though is if you can purchase this from a private seller. I mean, if you go to a private seller, they may be willing to sell this vehicle for a lower amount or lower price in order to avoid some of the other some because they're not going to be involved in financing or any of that sort of thing. Lease payments are lower than loan payments, and the advantage of a lease payment is that you get to drive a new car every year or every few years. However, there's a lot of caution to be taken if you decide to lease a vehicle, because at the end of the lease period, you don't own anything. You don't own the vehicle. You have to turn it back in, and basically you've been paying for the right to drive that car or vehicle for a period of time. Now, when you do turn that back in, they may be able to charge you if you've driven the vehicle higher a number of miles than what's in the lease agreement. So most leases limit you to about 12,000 miles a year. And if you turn the vehicle in where it's been used more than what they think it should have been, they may charge you a usage fee or something of that nature. So that's really all three topics wrapped up into one, and I wanted to conclude this discussion of buying a car versus leasing a car. We wanted to talk about student loans and avoiding high cost loans. Now, what's going to happen after you watch this video, and by the way, this is the end of the topic assessment where they ask a question about what makes a car a bad investment. Well, basically, it's answer A. As a used asset, car values always decline over time. All right, so that's it for Chapter 6. I'm going to post this video online, and shortly after I do that, you'll be able to access the homework for Chapter 6. Keep in mind that this week I've extended the length of time that you have to do the midterm. So you have through Sunday night, 11:59 p.m. to complete the midterm. And because of our current situation, you will need to do that remotely using the lockdown browser and monitor. Any questions at all, feel free to send me an email. I look forward to seeing your exam results shortly.